Welcome to the Thomson Reuters Idea of the Week and Alpha Now. I'm John Cozy. Investors get a lot of advice on what to buy, but not on what they should avoid, sell, or sell short. Many of our hedge fund clients tell us one of the toughest challenges they face is in finding a good source of short ideas. So, using StarMine's quant model ranks to screen for potentially weaker companies, here's what's turned up. Using the Thomson Reuters US Index as our universe, the screen was limited to $1 billion in market cap companies trading over $5 a share. We then took stocks with lower value momentum model rankings. It's our most comprehensive tool, combining separate StarMine models, two each using valuation and momentum. It harnesses the reversion to the mean behavior of valuation and the trending tendency of momentum. These work well when combined. Next, we looked at the short interest model ranks. Based on our research, you don't want to bet against the smart money. In fact, you may even want to play along. It turns out short sellers seem to be doing a lot of good fundamental research. Their targets are reflected in the short interest model ranks. The model includes the amount of shares sold short as a demand factor, along with shares held institutionally as a supply factor. When stocks are difficult to short, but the shorts are doing it anyway, the result tends to be big underperformers. StarMine found high short interest and low institutional ownership makes the best combination of success for short selling. Focus here on the upper left and the lower right boxes for weak and strong returns shown inside each box. We wanted to avoid stocks with high earnings quality. That's the probability of past earnings persisting into the future. So we filtered out firms with higher scores. And we wanted to avoid stocks still rocketing up or which have already blown up over the medium term. The result contained 43 names, but more than half of those companies are in just 3 sectors. Consumer discretionary, including Tiffany, Sotheby's, Columbia Sportswear, Under Armour, and JCPenney. Healthcare showed 7 potential mid-cap and small-cap underperformers, including BioMarin Pharmaceuticals, Cubis Pharmaceuticals, Immunogen, and VCA Antec. The materials sector did produce 2 interesting large-cap names, Alcoa and Martin Marietta Materials. Most of our names weren't large-cap. This indicates the more successful individual stock selections may come from the mid-cap and small-cap names. While short sellers may dive more deeply into these names, long-only investors may want to avoid them, at least in the near term. For the Thomson Reuters Idea of the Week and Alpha Now, I'm John Cozy.